you thought Kenya's central bank was over and done with raising rates, think again. They delivered another surprise rate hike to the markets today at its Monetary Policy Committee, the first with Patrick Njoroge as the governor. We'll be looking at the implications for that 150 basis points rate hike and a shock therapy coming from the CBK in this edition of Global Business. Welcome to the program. Here's what's coming up. The Greek Prime Minister Alexis Tsipras keeps the Eurozone in limbo over a new bailout plan. And ride prices are sparking tension between Uber taxis and local operators in South Africa. Now then, if there was such a thing as monetary policy defibrillators, we certainly saw that in action today. Kenya's new central bank governor used his first Monetary Policy Committee meeting to provide a huge dose of shock therapy to East Africa's biggest economy. The MPC raised the benchmark lending rate by 150 basis points to 11.5%. Governor Patrick Njoroge was formally appointed to the post late last month. He cited a combination of heightened risks to inflation, partially due to a weaker shilling, is part of the rationale for a rate hike. Now, the MPC also raised the Kenya Bank reference rate from 8.54% to 9.87%. The Kenyan shilling is struggling given a slump in tourism traffic and revenue, lower tea output and prices. And all of these have combined to reduce the revenue earned by the nation's biggest sources of foreign currency income. The shilling weakened to a 3.5-year low on Monday. It hit 100 shillings to the dollar for the first time since 2011 and continued in that very trend today. Now, Julian is an economic analyst at Stratlink Africa. He's with me in studio tonight. You guys must be pretty chuffed. You forecast a rate hike of some magnitude at the July 7 meeting in this month's notes to clients. Having seen the CBK's decision today, how does it compare to your expectations?
Roma, thanks for having me, first of all. I think it was really a matter that was foreseeable. We have experienced elevated monetary risks. Inflation has been edging up closer to the 7.25% upper limit target. And also the shilling has been flirting with the 100 units of exchange to the greenback mark. And I think if you look at all factors being considered, there was a highly likely factor that they would raise the benchmark rate further.
Indeed. What's the outlook, though, for inflation in the second half of the year? As you mentioned, yes, we are fairly close to 7.25%, about 20 basis points off that. But when are we likely to breach it, and what would drive it beyond that level? A recovery in oil prices, bad long rains, or just the weakening shilling?
I think what we can say with certainty, Rama, is the fact that we expect to see inflation continue to creep up through the remaining 2 quarters. But we can say with absolute certainty that this is the point at which it will cross the 7.25% mark, because a lot of factors come into consideration, and we would like to weigh the transmission effect of the hike just undertaken by the central bank, especially looking at it from a money supply perspective. We know that the levels have been high in terms of growth, but we expect to see this beginning to tone down in the coming 3 or so months.
Indeed. Speaking, though, of transmission effects, I can't remember the last time, aside from 2011, when we had a 300 basis point rate hike in a span of about 8 weeks. Is this likely to dampen, to push back government's borrowing plan for the fiscal year 2015-2016?
No, we don't anticipate that, actually, because if you look at the government domestic borrowing target is about 229 billion shillings in the financial year 2015-16. And if you consider that government consumption is actually a very key component of aggregate demand in the economy, it would be shooting itself on the foot to again tone down its domestic borrowing. And therefore, we don't expect that because it would again, the monetary tightening itself is likely to impact on growth, and therefore now we don't expect to see the government again now cutting back on its borrowing targets.
Indeed, but the flip side of the argument, Julian, would be that, would the government want to borrow at just about any price?
The question is where else would it source the revenue from? You and I know the tax net has been a challenge for the government, and therefore when it comes to options available on the table, it really doesn't have much on its options. So I think either way they would be compelled to play by the rules of the game.
Indeed, damned if they do, damned if they don't. Let's look at the correlation between CBR and GDP growth rates. How big a hit should you expect to growth in the second half of the year, given this 11% level of CBR?
I think it's important to begin by highlighting that a number of factors affect growth over and above monetary policy. But looking at it historically, if you look at between Q4 2011 and Q2 2012, we had a similar hike of about 200 basis points, and then we saw now growth decelerate from 5.4 to 3.3. But our expectation that we will see, if we are to see deceleration in growth, we'll see anything ranging between 4 and 4.5% in the next quarter.
Indeed, we'll leave it there for the time being. As always, thank you for your input, Julian. Julian Mboko there with Stratlink Africa, talking us through, of course, the latest rate decision by Kenya's central bank. Now, let's head over to Uganda. It's seen a slight decline in GDP growth due to a fall in agricultural output. The East African nation's economy grew by 0.3% in the first quarter of 2015, and that's slightly lower than the figure of 0.4% seen in the same period last year. Agricultural output was down 5.2% in Q1 compared to 0.5% growth in the first quarter of 2014. Now, the main contributors to the decline were food crops, cash crops and fishing. However, livestock and forestry did register an uptick in value. Agriculture is the most important sector of Uganda's economy. It employs over 80% of the total available workforce. Coffee accounts for the bulk of export earnings. The government is forecasting gross GDP growth of about 5.8% in 2015-2016. Now, this sort of thing doesn't really happen across sub-Saharan Africa, so hey, well done Tanzania. The government there has jailed two former Tanzanian finance ministers for 3 years for issuing illegal tax exemptions, which cost the government millions of dollars in lost revenues. Basil Mramba, age 75, Daniel Yona, 74, were in government and they issued the tax exemptions between 2002 and 2004. These tax waivers are granted to the subsidiary of UK-based Alex Stewart International. The East African nation is Africa's fourth largest gold producer after South Africa, Ghana and Mali. Up north in the meantime, in a bid to protect the local cotton industry, Egypt's Agriculture Ministry announced on Tuesday that it has banned all imports of the crop into the country. The government is looking to solve production and marketing problems which have seen the market for the country's high-quality, extra-long staple cotton, once dubbed the country's white gold, in decline for years now. This move signals a change of course after the ministry halted all-state support for cotton growers in January this year. It asked farmers back then not to grow the crop unless they had contracts in place to sell it. The ministry argued that it was simply too expensive to cultivate Egypt's long and extra-long cotton. Egypt's cotton traders say the production of the local crop has fallen dramatically since the 60s, with up to 2.2 or over 2 million acres in covering the crop to right now just about 300 to 250,000 acres. Let's get the latest details now from Yasser Hakim. He's live in Cairo. He's been following this story in detail for us. Yasser, exactly how long will this ban on imports last?
There's no time set for it officially by the government, but we know that it will probably be until they are sure that all the growers have sold their crops, or at least most of it, to ensure that they have managed to market their products and are making up for halting all types of subsidies to the growers. So it's just trying to make up for stopping the subsidies by helping them get rid or sell their products, their growth, their cotton, and then opening up the market for the extra needs or extra demands by the local market.
Indeed. One of the reasons cited for ending subsidies was the fact that there really just wasn't demand for the sort of cotton grown in Egypt. I mean, why were farmers so slow to switch to other varieties which the markets demanded?
Well, it's a lot of effort, a lot of money to switch your crop. And why should you switch when the government is paying you every year for what you are growing? I mean, the whole thing is that the subsidy issue has made it, if you can call it, lazy farmer who's okay with what he gets because he knows that at the end of the season he'll get his money from the government, whether he sells or not, whether he markets his product or not. It could be thrown away if need be. So the whole point is, even with the growth, the ones who did not change the type of cotton, they would change the whole crop, not just cotton. They would change completely to another product. Some of them would even change it into a land that's not agriculture but for real estate. So it's illegal, but it's happening a lot in Egypt. So the whole reason is mainly subsidies was the whole reason for all this slow process.
Indeed, I think we've just given MBA students quite the case study there in moral hazard. Tell me though, is there enough local demand from the private sector in Egypt to keep cotton farming viable?
Yes, there is enough demand, and the numbers say it. I mean, actually, Egypt imports much more now because the production here has dropped, like you said, maybe by more than the 3/4. So the demand is high, and even higher than what the production is. What's needed is to increase production so that you can cover the local market and export.
Indeed. Walk us through those numbers, though. I mean, you're looking at cotton imports doubling in 2013, 2014. What's driving that local demand? Why is there so much demand for cotton?
You don't get fooled by the numbers. Yes, imports have doubled, but it's mainly because the local market has not been giving you enough, have not been producing enough. If you talk about the imports in 2013, it reached around 74% of the total market. Now, the crop that has been produced in Egypt, the demand for it has dropped by 74%, and the imports increased by 1,000%. That's in 2012, 2013, mainly because there's not enough production. The companies here are not the companies that used to buy, the local ones, are not working well, so they cannot pay for the expensive type of cotton here, so they prefer to import at very cheap prices, very lower quality. They don't need the high quality at this point with the economic recession, so they buy from outside, from abroad, the cheap, low quality product. And so what you have is a tricky situation where you think that the demand is increasing a lot, but actually it's the demand for the type of product is the one that has changed.
Indeed.
So you end up with a lot of imports. You have the local market, but it's not giving you what you need.
Indeed. We'll leave it there for the time being. Thank you for the insights into Egypt's cotton industry. That's Yasser Kim live in Cairo. Quick round to the markets here for you. A fairly dismal set of numbers right across the board. Everything from Nigeria, South Africa, Egypt, excepting East Africa, which was relatively flat in this trading day, down in the red. Our next story might explain some of those numbers. A Greek Prime Minister is keeping Eurozone ministers in waiting over his bailout plan. And there's uproar among South African filmmakers over new visa regulations in that country. Africa is on the move. It's home to 7 of the world's 10 fastest growing economies. We help you make sense of the fast-changing African business landscape. We take you where the business is happening. Welcome back. 15 minutes into the hour, you're still watching Global Business Africa from the Kenyan capital, Nairobi. Now, leaders of the Ebola-affected countries, Guinea, Liberia and Sierra Leone, have met to thrash out a regional economic recovery plan. The West African Mano River Union state, which also happens to include Cote d'Ivoire, have met in Guinea's capital of Conakry. While there, they agreed to submit various funding proposals to donors. The first plan is expected to cost $1.8 billion. It will focus on health, peace, food security and private sector rehabilitation. The second has a price tag of about $2.2 billion. That focuses on transport, energy and communication infrastructure. The worst Ebola outbreak on record has claimed over 11,000 lives, and it has severely damaged the regional economy.
Il faut savoir qu'après la réunion de février 2015,
during this meeting, the project was approved by the European Union, which gave its support to these states with whom they're able to do an assessment of the plan. This plan was also submitted with the support of the European Union to the World Bank during a meeting that took place in Washington in April. These meetings have allowed us to allocate a cost to the plan estimated at $8.5 billion.
qui avait été adopté en février.
Right then, Greece's position in the EU continues to hang in the balance, although of course some analysts will say right now Grexit is essentially the only option on the table. The leaders of the Hellenic Republic and European leaders are currently locked in emergency talks in Brussels. The Greek Prime Minister is trying to persuade other Euro member states to reopen aid talks before the country's banks run out of money. So far, Mr. Alexis Tsipras has not tabled anything new beyond the plan he sent to the Eurozone before Sunday's referendum. That plan rejected a combination of tax hikes, spending cuts and pension and labour reforms. Germany and France maintain that the door is still open for a deal to prevent Greece from leaving the euro. However, they say it's now up to the Greek government to make the next move in talks on a prospective bailout programme.
Darüber hinaus
we certainly respect the democratic decision of Greece. However, it has not made the situation easier for Greece, according to our point of view. Everybody said that before the referendum, and this has happened now.
hat eine Position vertreten, die wir
délicate de la vie européenne.
Together, we need to try and find answers to these difficulties. The right response is to reinforce the Union, reinforce cooperation, and reinforce the Eurozone. This is because we've overcome these difficulties before. The best answer is to continue working on usual topics that allow us to move forward and help us give answers to our people.
Right then, those are the perspectives from Michel Sapin and Wolfgang Schäuble, the finance ministers of France and Germany respectively. Let's head over to Athens. Kate Parkinson has been there for a while now with more data on the story. Kate, you've been in Greece now for a while. We've seen photos of shuttered shops, long queues at ATMs, pensioners crying on the streets. What's the human cost of this crisis?
Well, yes, these have become fairly common scenes here in Athens and indeed around Greece as people get used to the banks being closed. They've been closed for over a week now. They're still going to be closed tomorrow, and there's no indication that they will open after that. And it's really starting to affect people. There's a limit on ATM withdrawals currently set at €50 a day, and people are concerned that that may go down even further. Some people are concerned that within a few days they may only be allowed to take €20 out of the bank every day. It's really affecting people. I've been speaking to individuals as well as small business owners who are really starting to feel the effect of this economic slowdown, economic collapse almost that we're seeing here in Greece. And it's certainly small businesses that are really suffering because apart from essential items like food and fuel, people aren't spending. We've heard that consumption is down by over 70%, and a lot of small businesses are concerned that if it continues like this, they'll be shutting their doors forever. There's already been 8,500 closures of small businesses this year. That's up 15% on the same period last year. And experts do say that if things continue as they are, if there isn't a change for the better, there will be many more businesses that shut down because people simply aren't spending.
Indeed, there were reports earlier today that the Greek negotiating team arrived without any fresh proposals for creditors. The Greek side has denied that, but give us an update on this. What's the actual position?
Well, yes, conflicting reports from the Belgian capital today. We heard from a number of Eurozone officials that the Greeks had turned up empty-handed with no proposal, much to their shock. They added the Greek officials denied this. They said it's not true. They said we do have proposals. Maybe it's just that the Eurozone officials don't want to hear our proposals. So, as usual, sniping between Greece and its Euro partners in Brussels today. We do know that a formal proposal from the Greeks will be tabled on Wednesday, but the big question is, will a deal be reached? And even if it is reached, will Greece be getting its hand on any bailout cash soon? Certainly some people saying probably not. Certainly a lot of experts saying it's highly unlikely that Greece will get any more bailout funds until July the 20th. That's the next big date for Greece, because that's when it owes the European Central Bank 3.5 billion euros. So that's a big date that everyone's looking at, and it does seem that it's unlikely that even if a deal is achieved, and even that seems unlikely at this stage, there won't be any more funds until after that date. And certainly for the people here, as I just mentioned, that is extremely worrying. Certainly if the banks stay closed till July the 20th, very worrying for people here in Athens.
Indeed, we'll leave it
and
there.
The rest of the country.
Indeed, we'll leave it there for the time being. Thank you for your inputs. That's Kate Parkinson live, of course, in Athens, covering the humanitarian cost of the crisis in Greece right now. On to South Africa. The Department of Home Affairs has been engaging with businesses in the film and the tourism sector in Cape Town to clarify, to deal with their concerns arising from some fairly controversial new visa regulations. Now, these industries are quite unhappy with those rules. They say they have adversely affected the operations and led to losses. A rising tide of opposition to these new entry requirements still seems to be a very thorny issue with stakeholders. They argue that South Africa needs tourists, investments and more jobs. Travis Andrews has their argument on what's hot tonight.
Since South Africa implemented new visa regulations, there's been a complete uproar from the business, tourism and film industries, who believe they've been negatively affected by the new legislation. The new visa requirements were defended by the Department of Home Affairs Deputy Minister Fatima Chouhan, who participated at a visa workshop meant to clarify some burning issues that were clearly on the agenda.
It's been over a year since we've implemented the new regulations, and we are of the view that the regulations actually, in many respects, make it easier to do business in South Africa and does facilitate economic development and promote our national interests.
But that view is not quite in concert with the Grant Thornton report into South Africa's visa regulations, which paints a far gloomier outlook for the affected industries.
The reality is that report demonstrates something around the region of 21,000 jobs, and as I recall, 10 billion rand in lost revenue. South Africa can't afford that. We're facing a crisis of unemployment, of inequality and of poverty. We have to be in a situation where every single policy, every single government department and business works together to grow this economy.
Cape Town is the film hub of South Africa, but since the visa regime has been in place, many local production companies have lost work and have also been unable to draw in top talent.
With the larger network shows and feature films or films where your package is so important about what is your cast, who's your director, the negotiations often take very long because all kinds of elements happen. And the fact is now almost is that our South African visa process is driving the talent pool.
The tourism industry, according to stakeholders, has been one of the worst hit. Firms like Cullinan Holdings have taken a 70% drop in their main market in China. They're already trying to mitigate against their future losses.
If we have the right information, we can communicate it clearly to our tour operators and to the industry in China and make sure that the right messages are sent out, which is clarity around when visas will be implemented, under what basis for biometrics, how many centers, etc.
The Department of Home Affairs does plan to introduce biometric facilities in the next financial year that will hopefully ease the process on South Africa's entry requirements, which has during the last year been somewhat of a burden to some. It seems there's no common ground at the moment between the Department of Home Affairs and these critical industries. However, all stakeholders are open to further dialogue so that hopefully this persistent issue can finally be resolved. Travis Andrews, CCTV, Cape Town.
Right then, commodity prices, oil of course still tumbling, Brent crude at around $55 a barrel. Over in Nigeria, however, the government says it will be sharing out about $1.8 billion in revenues from gas between all three levels of government, but that won't be enough. The debts that are due by governors is actually $3.3 billion US. Uber is right at the centre of another controversy, this time in South Africa. We'll have the details next. Welcome back. Let's talk about Uber. It's facing challenges in many of the cities in which it operates right across the world. In South Africa, it seems that a lack of laws and regulations to run the country's taxi sector, or at least to adapt to new challenges, is right at the core of the problem. Uber drivers are facing harassment following a protest last week by taxi operators who compete with this personal service. Angelo Coppola has the details.
They've been called market disruptors, new kids on the block, and exploiters. But there's no question that they are turning the metered taxi industry upside down, and the popularity of the business is hitting new peaks. Consumers are flocking to the service, and this is causing tension between the two market players. Last week, an Uber driver was allegedly threatened and a passenger harassed.
It's not something that happens. I think it was just an isolation incident that actually happened. It's not something that happens like on a daily basis. In fact, I have never been intimidated by any taxi guys.
It appears that it's about pricing. New market entrants generally need to find traction very quickly, and the simplest way to do this is by undercutting prices. There are two categories where pricing is comparative, but Uber has chosen one sector to make inroads.
Personally, I don't have any problem with Uber, but I have the problem with how they operate, specifically their pricing. You understand? Like in every market, there is regulated prices.
The problem lies on Uber X, which charges half the price, which is R7.50 a kilometer. That's where the problem lies. That's where there is all this controversy, the whole of South Africa.
There's some criticism about the Uber business model, in that it requires late model owner drivers, or partners as they're known. But it's a question of the amount of effort and time you want to put in.
You are prepared to put in the hours, because I must say, for you to generate or to make a decent income, you have to put in the hours, because it's like no work, no pay.
Some in the metered taxi sector also wonder about whether drivers are actually empowered.
So if you are a partner, you must have a say on every decision they do. But with the owner drivers, they don't have any say.
While Uber is facing competition in many parts of the world, in South Africa there seems to be a little bit of an undertow of violence when it comes to the incumbents, which are the meter taxi organizations, and Uber, which is positioning itself as a technology company. The bottom line is there are tensions, but they are isolated. I'm Angelo Coppola for CCTV in Sandton, Johannesburg.
Right, and now a quick run through currencies here for you. The South African rand at around 12.51, still of course feeling the aftershocks of Sunday's referendum. The Kenyan shilling at 100.5 to the dollar. Let's see if the shock therapy coming through from the central bank will have an effect on that exchange rate tomorrow. That's it for this edition of the program on Global Business Africa. As always, we value your feedback, your thoughts and your ideas. Send them to globalbusinessafrica@cctv.com. As always, Facebook and Twitter is where the news continues 24/7. See you in 23 hours. I'm Raman Yang. Thank you for watching.